Selling covered calls is a strategy that many people use to generate some additional income. It's also simple enough to set up that a lot of people that are new to options feel pretty comfortable executing these types of trades. So today I want to walk you through an example on Fidelity, exactly how you do this from A to Z. I also want to explain to you when you might use this and how the strategy works. Hi, my name is Dave, and on this channel we talk about building wealth with the idea that we're going to show other people that they can do it too. So today it's all about selling covered calls. Stick with me. Whoop! First, let's talk about the mechanics of selling covered calls. Well, first off, you should be buying stocks that you like. This is critically important and something that I talk about whenever I'm trading options. I don't want to buy junk. I want to buy stuff that I would want to own long term in one of my accounts. So as long as you follow that rule, you're off to a good start. So now you're starting accumulating the stock that you like. You buy 10 shares today, 10 tomorrow, or you buy all 100 today. Either way, you want to get to 100 shares so that you can sell one contract, because that's the covered call portion. You have 100 shares, and then we're going to set up our trade. We're going to go sell to open one contract, which is 100 shares, at an agreed upon expiration date. Maybe you pick 3 weeks out from today, right? And an agreed upon strike price. Maybe your average buy price was 80, so you say, I want to sell to open at 82. Now, they're going to have to pay you a premium because you sold this contract to them, right? So you get to collect that premium. Maybe it's $50, I don't know. And then you're going to have the waiting game begin. And then we know what happens, right? 3 different things. The stock goes up past 82. If it exceeds 82 by the expiration date, they're going to call it away from you. You no longer own the shares, but you get to sell it at 82 and you keep your premium. If you trade sideways, eventually the thing's going to expire. On the expiration date, you're going to keep your stock plus the premium, and you're going to repeat the same process probably. Again, selling that at 82 and collecting another premium. The third one is one we got to worry about, and that's when the stock starts to go down, deteriorate, drops out of there. Then you got to decide what you're going to do. In the middle of that, you could buy to close, right? Because you sold to open, now you can buy to close. If you buy to close, you have to pay a little bit because that's just like giving some of the premium back. Or you could wait till it expires and then decide what to do from there. So those are the 3 legs. That's what could happen, and that's how the mechanics of this trade work. So let's do a quick analogy to kind of tie this together, this idea, right? So imagine you go to a garage sale and you find toaster ovens. The guy's got 10 toaster ovens sitting there, and he's asking $100 a piece, but you know, retail-wise, they're $160 each. So you buy all 10 of them, and you realize you need 3 at home. You want one on each floor of the house, right? So you put one there because you keep some. And then you have 7 left. You have these 7 that you decide you want to sell on eBay for $120. Because just like a stock that you go buy, when you find it, it's undervalued, because that's what you hunt for, right? And then it grows over time. You're not willing to sell it for what you bought it for. You want to sell it at a higher price. So that's the same thing we're doing with covered calls. So when you buy these toaster ovens and you go out and you want to sell them, it's just like you've been accumulating a stock that you really like. And over time, you buy 50 shares, 60 shares, 100 shares, and you accumulate these, right? You have 500 shares, just like the toaster ovens. And now you have way too much. You're way too concentrated in this one particular stock, as we would say. So you want to rebalance. Well, that's a perfect situation where you would use covered calls. So you have your 500 shares, but you only want to have 300, right? And the stock's at 80, but you feel it's worth 90. So you're going to sell the covered call at 90. You're going to be patient, but you know you want to get rid of it because you still feel it's undervalued, just like the toaster ovens. Does that make sense? So you go out and you start selling these $90 call option, right? You sell it, you collect premium. Eventually it goes up. It's a good stock. You picked a good stock. And it sells and triggers that event. You get rid of all your toaster ovens or all your stock, right? And now you're not concentrated anymore and you're rebalanced. So that's a perfect situation or scenario where this might occur in real life. Now, rebalancing your portfolio this way doesn't happen that often, but what usually does happen for me is I use this strategy when I'm trying to generate more premium. It's premium driven. So let's say a stock's trading in a particular range and it's at the bottom of that range. Well, if I go to use my normal strategy, which is trading the wheel, I'll look at the premium that I can collect for the current stock price, maybe just a few points below that. And I'm looking at it saying, I really can't get much premium from this. So that's when I start looking at the other side of the equation, because everybody's expecting the stock to go up. So you'll start noticing these premiums go up as well. So when I go to, instead of sell a put, I start to sell a call. I look at those premiums, and if it's substantial enough, then I'll buy the stock and I'll sell the call. For me, selling covered calls is more of an opportunistic strategy. So I like to trade the wheel, but opportunity does present itself in the form of buying a stock, turning around, and immediately selling the call. And I'll walk you through something that I just did to kind of show you what I'm looking for. Okay, so here's an example from this week where I think opportunity presented itself. So I executed this type of trade. This is ticker symbol VZ, which is Verizon. Everybody's pretty familiar with this. And here's a chart. And what you see on this chart is a 1-year chart. The little blue dots are dividends, so those are important. And the yellow line is the 50-day moving average. And then the green and the blue are the support and resistance bands. So as you can see where we're at right now, we're down towards the bottom support there, and we're below the 50-day moving average. So I'm looking at that, and I decided that a good trade here would be to buy 300 shares of Verizon at $55.89. And we're going to do this exactly. I'll show you what I did on Fidelity. And turn around and immediately sell the $56 call option. So with an expiration of 7/16. So if this executes, I make $33 because that's kind of the setup, okay? And for doing this trade, I got to collect a premium of $105.94. So that's the setup. All right, so why did I make this trade? Well, all the factors that we talked about, right? It's below its 50-day moving average. It's toward the bottom of its range. So I think it's probably due to go back up, right? So I'd feel pretty good about just buying and owning the stock. But we also have another big factor, which is the ex-dividend date is coming up. You see where the last dividend was paid. The next one is due on 7/8 is the ex-dividend date. So that's the date you want to have it. That's the date you want to actually own the stock so that you get paid that dividend. Because it's 63 cents for every share you have. So for 300 shares, that's going to be $189. So if I combine that along with the premium I've collected, I'm just under $300. $300, 300 shares equals $1 of what I would call like downside protection, right? So I bought it at $55.89. I'm going to collect $300 probably, worst case scenario. That means it can go all the way down to $54.89, which is really low for this particular range. And that's my downside. Upside is it flies through the roof. They call it away, and I collect my premium plus the dividend. There is a chance they call it away before the ex-dividend date, but that means my time that I actually held this was even shorter. So the collateral that I had was really short. So the return that I has is been concentrated, and I can put that money back to work right away. So in all these scenarios, I'm making out pretty darn well. So yeah, when opportunity presents itself, this is a great strategy, and that's one example. I'm going to keep my eyes out when these ex-dividend dates occur. I'm going to watch when earnings are coming out. I'm going to pick the stocks that I really want to own, and opportunity will present itself. Now I want to take you over to Fidelity and show you exactly how you would execute a trade like this, that Verizon trade that we just talked about. Also, if you wouldn't mind, please like and subscribe to the channel and click the notification bell for future content. So over in Fidelity, let's take a look exactly how you would set this trade up. So the very first thing you're going to want to do is buy 300 shares of the stock you're looking at. So in this case, it's Verizon, and I ran out and I bought 300 shares at $55.89. So I'm not going to show you that exactly, but trust me, I bought the 300 shares of Verizon, and then I'm going to go set up my my option here. So you pull up your options box, trading box as you see here, and you set it to ticker symbol VZ. Strategy is calls and puts. My action is sell to open, right? And I'm going to do 3 contracts. 3 contracts, 300 shares, sell to open. Expiration, July 16th. That expiration was specifically chosen to be a little bit further away from the ex-dividend date, which is 7/8, and before the earnings date of 7/21, which we'll look at. So it's kind of in a sweet spot between those two. Strike price is $56 a share, so not much above what I paid for it. So I'm going to get very little in stock appreciation if this goes through. But my focus is on the dividend and the premium. Now, if I have both of those, I'm going to be doing pretty well in this trade. Now, the next part is I'm going to be doing a call, right? And I'm selecting the order type of market because the spread between the bid and the ask is not much, and my guess is it's going to end up at the midpoint anyway. So I'm going to execute this transaction, And if we go over and we take a look at the results from this trade, we're going to end up with a gain of $105.94. So it did execute at 36 cents, right in the middle between the bid and the ask price. So after commissions and fees, $105.94. That's my premium. That's what I keep. And I'm off and running. Now we know three things can happen. Stock goes up, sideways, or down, and we know what the results are in all three situations. What we don't know is if it could get called away from me early. And that's when I talked about that sweet spot of 7/16 expiration, a little bit further away from the 7/8 ex-dividend date, which means on 7/7, you need to own it at the end of the day. That's confusing a little bit, I know, but own it at the end of the day on 7/7 in order to get the dividend. So I'm hoping that it stays right around that $56 range and they don't care enough to call it away on 7/7. If they do, then I get my money back and it gets executed at 56 and I make a little bit on the stock appreciation plus my premium. So I'm feeling pretty good either way. But all scenarios, I think I'm pretty well covered. So we will see how this plays out. And in a week or so, I'll post something down in the comments to let you know exactly how it turned out for me, so you're aware and we can see, did we do all right? But yeah, it executed. One other thing, Seeking Alpha, Fidelity, you can use a lot of that information, but you can go out and you can find those ex-dividend dates. I'm going to show you here on Seeking Alpha where you would find it under the dividends tab, and you can also find earnings are on 7/21 under the earnings tab. So that's it. That's how you would do it on Fidelity. It's simple, and we're off and running. Selling covered calls is a great strategy for anyone that wants to learn about options. It's very user-friendly to get started with these, but it's also very powerful and can put a lot of money in your pocket when used properly. So go look for those opportunities. If you have any questions about any of this stuff, please ask down below. I'm not a financial advisor, but I'd love to give you my opinion. Just keep in mind, that's all it is. It's my opinion. So if you have any questions at all, again, ask down below. Like and subscribe. Please have a great night. Take care. Whoop! This is the dog that makes it all happen. Have a great night.